we're going to talk about long-term bonds. And I occasionally run into somebody who advocates for including long-term bonds, particularly long-term treasuries, right? These are treasury bonds, loans to the federal government of 20, 25, 30 years in your portfolio. And you can do this either using, a mutual fund or an ETF, or buying the bonds directly at Treasury Direct or through your brokerage. It's really kind of the same thing, no matter how you do it. But there are some downsides to investing in long-term bonds, right? The two main risks when it comes to bonds are default risk, right? Credit risk, that the person you loaned the money to or the institution you loaned the money to doesn't pay you back. Well, that's pretty darn low if you stick to just treasuries. The other main risk is interest rate risk, right? The possibility of interest rates going up and causing the bonds you own to be worth less, because people can buy bonds that have significantly higher yields now. And that risk really showed up in 2022. 22 historically is the worst year we've ever had for bonds. Interest rates went up about 4% that year. And so it just devastated bond returns, because this, significant risk with bonds really showed up in force. And of course, when you have short-term bonds or even intermediate-term bonds, that risk wasn't so bad. Short-term bonds lost single-digit amounts that year. Cash didn't lose anything. In fact, they were thrilled to see their yields go up. Intermediate-term bonds might have lost as much as, low double digits, 10, 12%, which is a terrible year for bonds, right? Historically, you almost never lose money like that. But the long-term bonds got devastated, right? TLT is an ETF that just invests in long-term treasuries. I think its return in 2022 was worse than minus 31%. I mean, that sounds like a stock, bear market, to lose 31%. And to do that in what's supposed to be the safe portion of your portfolio is pretty unappealing to me and to lots of people like me that don't like seeing that sort of volatility out of the safe portion of your portfolio. Now, the argument people make that are all for including these long-term treasuries in their portfolio is that when things get really bad for equities, the bonds that tend to do the best are the long-term treasuries, right? Interest rates often get cut. And when interest rates go down, the longer-term bonds are have the best returns. And of course, when there's a flight to quality, when there's a flight to things that people think are going to be liquid and are going to be safe, they tend to prefer treasuries, and in fact, actually prefer nominal treasuries even over tips. And so that's the theory. Well, you got to look at the whole portfolio, right? And when you have long-term bonds in there with stocks, maybe they provide the best, opposition to stocks in that respect. And there have been portfolios that have used long-term bonds over the years. Maybe you've heard of the permanent portfolios, like 25% stocks and 25% gold and 25% cash and 25% long bonds. And the theory is that each one of those assets will do well in a certain type of economic situation. The problem is, the economic situation where stocks do best is actually the most common one. And so only having 25% of your money in stocks has significant downsides in the long run. But this isn't necessarily a new idea, but I feel like the people pushing it and the discussion I'm seeing on it in online communities is a bit more prominent than I've heard for a long time. So if you decide to do this with your portfolio, a couple of things. One, you've got to look at the performance of the whole portfolio, because this is going to be a volatile asset class. Hopefully volatile in a good way for you a lot of the time, but also at times a year like 2022 is going to show up and you're going to lose a whole bunch of money in bonds. Now, if you own individual bonds and maybe you look at it as, okay, well, I don't lose anything because I'm still getting the same deal by the time I get it back. But you got to be okay with that, number one. Number two, you got to be okay with significant inflation risk. Okay. This is another significant risk with long-term nominal bonds. Like when I see people getting out into these, long-term treasury ladders, I prefer them doing it with a TIPS ladder. If they're trying to provide spending money for the year they turn 82 and they're buying it when they're, 58 or something, I like to see that be a TIPS. So at least it's indexed to inflation. Because if we get 9% inflation like we had a few years ago, and that persists for 3, 4, 5, 6 years, that's going to take an awful lot out of the real value of those long-term treasuries. So be careful with that sort of a portfolio. I think it's a little bit faddish. I prefer taking my risk on the equity side. So not only do I keep the quality of my bonds high, but I tend to keep the durations, the maturity, the length of these bonds, the term risk of these bonds relatively low with short term and maybe some intermediate term bonds. So be careful if you decide to add the long-term bonds to your portfolio, but it's possible that that'll work out well for you in the long run.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.